your rental market is weak, which means that you're not going to find a tenant easily. You'll be lucky to find a tenant between 1 to 2 months. So when you buy these expensive Melbourne properties, you have to face a lot of negative cash flow issues. I want to give a very clear warning, especially if you're looking to invest in Melbourne in 2026. Yes, I do agree that prices are rising in Melbourne. Things are overall looking good over there, but that does not automatically mean that every asset type is good, every market is good. So in this video, I want to talk about the mistakes that investors are doing. I'm seeing them buy the wrong asset type in the wrong markets and lose money. So if you're someone who's investing in Melbourne in 2026 and want to make sure that you take the correct decision with your investment, then this video is for you. If you already don't know me, my name's Jadu Srikandan. I'm a buyer's agent for property investors, and over the past 3 years, I've bought property in every state in Australia using a data-driven approach. So if you want to work with me, then go to my website propertyframeworkbuyersagency.com.au and book a session with me there. Now I want to talk about these mistakes one by one. The first one might seem a bit obvious, but hear me out because the numbers are a bit surprising. In fact, it surprised me when I actually looked at how big this problem was. So the first one is buying apartments in Melbourne CBD. Let's look at more data around this. Now, if I look at the size of the Melbourne CBD market, the unit market in particular, right? I see that it's the second biggest after the Gold Coast. So we have Gold Coast at first, and then we have the Melbourne CBD market. Then we have Sunshine Coast, Sydney, and Brisbane CBD. So it's one of the biggest unit markets in Australia. Okay, and if you look at the past 3 months, now this is just from realestate.com, I can see that 359 units have been sold in the postcode Melbourne Victoria 3000. So I'm just looking at that 3000 postcode alone. We had 359 units sold, and majority of these were actually purchased by investors. So investors are still buying these high-rise apartments in large numbers, at least 100 per month. That's about 1,000 investors buying Melbourne high-rise apartments every year. Now, is it really bad, to buy an apartment in a world-class city like Melbourne? Let's kind of take a step back, right? Now, in Melbourne, like I said, it's a global city. It's got all the amenities. Everything's perfect. But yet, over the last 10 years, we've not seen any type of price growth. You can still buy an apartment in Melbourne CBD for under 400,000. And you can buy this in a remote regional market in Australia for the same price as well. So you're having one global city and one remote regional market in Australia, and the unit prices are the same for both. So something has gone wrong somewhere. Okay, so let's kind of take a step back and really try to understand what went wrong. So let's just look at the data for the apartments, right? So this is the price change, and what I immediately see is that over the 10 years, nothing has changed, minus 0.13. Over the past 5 years, Melbourne apartments went through a drop of minus 2.40. In fact, you can buy apartments at the same price they were in 2010. Right? There's no change in the apartment prices. Okay. If I go further down, I can see that 71% of these Melbourne apartments are owned by investors. Okay. So it's only 29% owned by own occupiers. Another interesting thing is that the ERSAT score here is 10. Okay, so we have an affluential population living in these apartments with very high incomes. And despite these high incomes, despite the affluence, prices haven't moved. So let's really see what happened there. To understand that, we need to understand what happened to Melbourne just after that COVID period, okay? This was an analysis done by John Lindemann. In fact, he released an article talking about Melbourne's CBD apartments recently. So I'm just going to summarize what he talks about in this article, okay? So essentially, after the COVID phase, the Melbourne unit market was doing well. We had investors who were doing Airbnb. Then we had foreign investors who bought these apartments and just left them vacant without renting them out. Okay, so there were two types of investors, and the market was doing fairly well. There were also some owner occupiers buying, so it was fairly good, right? But then what happened was that the government wanted more long-term rentals. They didn't want the properties to be vacant, and they didn't want too much of short-term rentals, right? So they wanted long-term rentals. So for these people who were renting out as Airbnb, they had a surcharge, a 7.4 surcharge on top of the booking fee, so that they wouldn't have so many short-term rentals there, right? And to discourage overseas investors who were buying all these apartments and leaving them empty, there were two different taxes that were imposed on them, right? So one was the vacant land tax. Now that was increased from 1% to 3% of the property price every year. Every year it was left vacant. You had to pay 3% of the property price. And then there was a non-resident tax, which was 4% of the property price, and that had to be paid every year as well. So which means that overseas investors, and generally these investors, they didn't want to continue. They sold all these properties suddenly, and we saw a huge wave of properties hitting the market. Let me share that with you here. So if I look at SQM research here, I can clearly see that since 2022, you can see this surge, or 2020, you can see this surge of apartments. This is just apartments in the postcode 3000. So you can see them rising from about 500 to about 1,000, right? That's the reason why there's an oversupply of apartments there, and prices really haven't taken off. Even during that COVID phase, prices didn't really take off for Melbourne's apartments. So that oversupply hasn't been absorbed yet. And let's look at it from a rental perspective, right? So if I open this up, I can see that 1,314 properties are vacant in Melbourne CBD right now. 1,314 properties. Okay, if I look at ABS data, I can see that there are 16,357 properties, rental properties in Melbourne CBD. So that's a very high vacancy rate, around 7 or 8%, right? So your property price is not going to move up in value. At the same time, your rental market is weak, which means that you're not going to find a tenant easily. You'll be lucky to find a tenant between 1 to 2 months. You'll have long periods of vacancies in between tenancies, which means that your cash flow is not going to be good either. So no price growth, and cash flow is poor too. And which means that it doesn't really make sense buying Melbourne's apartments in the CBD right now. So that's the first biggest mistake that I see investors making. Now let's move to the second one. Now the second one is where they're buying houses, but these investors are just looking for newer houses. They want to buy newer houses, low maintenance, set and forget type of investments. So they are lured to these areas where new houses are being built. The only problem with these areas is that the vacancy rates are very high. A lot of investors are doing the same thing, and because of that, the vacancy rates are really high. Let's look at some numbers here. So I've got some suburbs in Melbourne here. So we've got Kalkallo in the north, Beveridge, we got Donnybrook, we got Wyndham Vale. So all these suburbs, right, the vacancy rates are very high. If I take one of these suburbs, Fraser's Rise, for example, right, it's very affordable, still quite affordable, 600 to 700,000. You can buy properties in that bracket. So very attractive to investors, and the fact that you can buy a new house in these areas. Now, if I look at Fraser's Rise, right, and go to the suburb of Fraser's Rise, there's 110 properties in the market available for rent. 110 properties which are just there, which are vacant, which don't have anyone living there, right? And these are all new properties which are, which been listed recently, and properties which have been there for the last 2-3 weeks, right? So what does this mean? So 110 properties, and the total number of rented properties in Fraser Rise is 450, okay? Now let's look at the numbers. 450 rental properties altogether, 110 of them are vacant, okay? And that means the current vacancy rate is 25% in Fraser Rise. Can you see how many investors are rushing into these markets, buying properties, not looking at the rental aspects of things? Now, what does this mean? It means that it's going to take long to find a tenant. It's going to be 2 or 3 months to find a tenant, right? Until then, you'll have to pay the mortgage yourself. In between tenancies, it's going to be hard again because the vacancy is still very high. So overall, you'll be losing money through your cash flow, right? And this doesn't really work well over the long term, right? You want to buy into areas where vacancy rates are very tight, where it's hard to find rental properties and people are competing to get these rental properties. If you buy into these loose rental markets, then over the long term, the investment is not going to perform well. So be very careful about buying into these investor hotspots where a lot of investors, together with buyers agents, they might be buying it themselves. A lot of investors want to buy these new low set and forget type of investments, but they don't really think about the rental market and how long their property is going to be vacant for. So that is another very important factor to look out for when investing in Melbourne. The third thing, and I think this is very relevant as well. I know a lot of people compare Melbourne and regional Victoria. And let's say they've got a budget of 650,000. They don't want to go into regional Victoria. They want to buy into Melbourne. They want to compromise on the asset, meaning that they want to buy houses with small land components, less than 300 meters squared sometimes. And the idea is that, oh, it's Melbourne, it's a capital city. Why should I buy in a regional market when I can get better growth in a capital city? That's the thinking that they have. But in fact, you might get better performance if you go into a regional market with your 650, buy a better quality asset, maybe even a 4x2, buy that in good condition, and also buy into a better market, into a better area where the supply-demand dynamics are really strong. In fact, the regional market, the regional Victorian market, for example, might outperform the Melbourne market, right? So, but I see a lot of investors trying to rush into Melbourne with their budgets and buying assets that are not really good quality, especially with the land size, right? Buying 200 meter square blocks, 300 meter square blocks. The problem here is that the capital growth tends to be slightly lower when you have these smaller block sizes because it's the land that appreciates, not the buildings, okay? And during a market downturn, it's always harder to sell these smaller land sizes. Even if you're in a capital city, it's going to be harder to sell. So the better choice would be look at better options outside of Melbourne where you can get better returns on your investment. And this is a very, very common mistake that I'm seeing in playing out in Melbourne right now. And the fourth point, and this is very relevant as well. People are buying properties in Melbourne, especially investment properties at 900,000, 1 million. Okay. A few years ago, we were buying investment properties in Perth for under $500,000, right? Now the price of these Melbourne properties are 1,900,000. And as you know, Melbourne yields are not that good. We're talking about 3% rental yields. So you're going to be heavily negatively geared. You have land taxes as well that you have to factor in. So when you buy these expensive Melbourne properties, you have to face a lot of negative cash flow issues, right? It's going to be 20, 30,000 negative out of your pocket. And if you are someone who wants to buy other investment properties, this can seriously hurt your chances of buying further properties, okay? Because yield matters. The cash flow matters, it matters for the bank, and therefore it's going to affect how many more properties you can build, or how many more properties you can buy, and the speed at which you're building out your portfolio. It also impacts your lifestyle because of this heavy negative cash flow. So the thing is that people are lured to Melbourne. They think that, oh, higher price points, this means that this is going to double. My 900,000 property is going to become 1.8 million, maybe in 2 years. And that negative cash flow, I can just forget about that, right? But the reality is not like that. Yes, there will be capital growth, but there's always that negative cash flow that you really have to manage. And as investors, we've got to be really careful about our cash flow. Those are some very common mistakes that's happening right now in Melbourne. Okay, these are not hypothetical examples. These are real investors who are buying these properties. So if you're someone who wants to buy in Melbourne in 2026, be very selective of your investment. Also take into account your personal situation, your goals, and make sure that you make the right choice. That's it from me in this video. I'll see you again next week with another video. Thanks.